Well, there is no question demand from the big emerging markets is driving coal, and right now none more so than from China, the world's biggest coal user. And that demand is leading to forecasts of a much higher coal price in 2010. To look at coal and what's happening with other commodities, I'm joined by Jonathan Barratt from Commdity Broking Services. Jonathan Barratt, welcome to Business Today.
Good morning, Ali.
We've just heard about coal mining in Indonesia, but it really is China and indeed also to an extent the US, given the bad weather they've had, that's really driving coal at the moment, isn't it?
Yeah, Ali, it is. It's quite an interesting situation because we've got the coldest the coldest winter in 9 years in the US, and Chinese imports for coal are up 41% on the same time from last year. So we're actually reaching this period where we just really don't, or perhaps don't have enough coal to meet this demand, which we're seeing at the present.
Well, we've already seen coal prices go up. How much higher do you think they can go? I've read one analyst saying that they're forecasting a spot price, well, much higher than where it is today.
Yeah. Well, if you think of prices around that $59 US dollars a metric tonne, and we've just seen a spike in the spot prices just in the last week. There are feelings that towards the mid of the year and towards the close of the year, the prices could be upwards of $65 to US $70 a tonne. So I think there is this significant climb which we can all expect.
What about iron ore? Again, there are also price forecasts of big increases, $100 a tonne for the spot market by the second half of this year. In terms of Chinese demand, it's very much the same story as it is with coal?
It is, but I think there's a little bit of a different story developing in China, because what we're actually seeing is that the Chinese iron and steel group are actually not, or they basically had problems last year with the price negotiations. So some of the mills in China are actually going direct to Rio and BHP. Now, you're probably aware that Rio and BHP, and for that matter Vale, are actually looking for a 40% increase in the price of iron ore. And we're just hearing today that some of those mills, I think it's about 5 or 6 of the mills in China, have gone around what China Iron and Steel have said and actually agreed to this 40% increase. So it's going to be quite interesting to see how the China Iron and Steel Association works with its other mills, because the mills are seeing this demand pick up and they actually want contracted prices. So it's going to be a good space to keep an eye on.
But indeed that 40% though, is that likely to flow on? Because it does in itself, if it is as reported, it would seem to suggest that the benchmark has been set.
Look, I think you're basically saying that benchmark, I think, will be set. I think we want to see confirmation that the China Iron and Steel Association are saying, well, look, that's an okay price. Remember, last year they had major problems, and particularly when we had the concerns with Rio, that there wasn't really a benchmark that was sent, and that the Chinese mills actually had to pay the spot price, which was substantially higher to any benchmark that was offered, say, to Japan and the like. So it's going to be an interesting period, but the way we're starting to see things is that China, after its new year, could actually come out of the blocks, and could be a little bit of shortage in terms of what they require.
At the same time, how does that sort of forecast sit with the recent tightening? Of course, China tightened again just before the New Year holiday. Is that putting a lid on prices? It's certainly causing some jitters on the markets, but is it likely to put a lid on prices in the longer term?
I think it's how you view it, and I think this is where I think some of the analysts it's a little bit mixed, because some analysts are saying that, well, they're reducing their stimulus packages, therefore the demand for commodities won't be as much. I'm actually viewing it slightly different, to saying, well, look, they're trying to slow down things as much as possible because the economy is moving so quickly. Remember, the loan book that China had in the first month of the year was treble that of October, November and December. So there's a lot of money now that has been thrown into the manufacturing area in China, and I think as a result, China actually obviously moved on its interest rates to try and slow it down. But I think that's a lagged effect, and I think you might find that they'll come out of the blocks looking for more commodities, and prices should resume their trend higher.
Jonathan Barratt, just a final question, and away from China, if we can have a look at gold, because we've got the IMF gold sales, we've also got the sudden increase in the discount rate by the Fed in the US, which one would imagine would hurt gold, but those moves haven't. Is gold really more a dollar story at the moment than a commodity story?
Yeah, look, it appears that there's actually some anomalies in not only the gold market but also, say, the oil market, where we're seeing, and this is where I think it does pitch back into this US dollar story. You see these negative fundamental stories coming through, just like in oil, where you see massive inventories continuing to build, yet the prices continuing to trade higher, which in my mind suggests that it is more of a US dollar story at the moment rather than the actual fundamentals in that underlying commodity. Gold has broken through a significant trend line, which had it at its high around about that 1220. And I think if it stays above this 1100 level, then there are expectations, if the US dollar continues to weaken, that gold could see it surpass that 1130 and even trade higher to that 1170 and maybe 1200 in the not too distant future.
Jonathan Barratt, many thanks for joining us.
No problem, Zoe.